Q2 market update, market insights. For those who don't know, at Zenith, we work with individuals and families. We also work with institutions and business owners to help them strategic plan and investment manage. And so as a part of that, we're keeping our eye on the markets at all times, and we're managing those dollars. And so we love to not only give you what we're seeing, but also be able to communicate it in a way that's easy to understand. And so we'll be doing that today. I'm Andrew Tudor, investment advisor here. I lead our institutional work and, from Cincinnati, Ohio, currently in Charlotte, North Carolina, kind of globetrotting around, but the whole time been in the finance industry. And it's been a great quarter this quarter to really recap. So before we jump into what we've seen and what we're looking forward to, I'll kick it over to Jason as well. Introduce himself.
Thanks, Andrew. Yeah, like I said earlier, great to be here again with you this quarter. We got a lot of really interesting stuff to talk about. In my role at Zenith as the Chief Investment Officer, I think a lot about markets, how the economy impacts our clients, the businesses they're running, the institutions they're serving, and their families that they're planning for. I've been in the industry just over a decade, grew up in Detroit, which is where I am actually right now for the summer. I've lived in Philadelphia for 11 years. So excited to dive in. I'll kick it over to our agenda slide just to talk about what we're going to be doing today. Just giving a recap of the market, doing a pulse check with all of you, giving our outlook, and then providing some takeaways. We will have time for questions and answers. If you have questions before the end, please throw them in the chat. We've already got an extremely active chat. Thank you. If you just joined us, everybody threw in the chat what their highlight of the summer has been. I encourage you to do the same if you didn't see the prompt earlier. I think just to start to dive into it, we saw, if you see there on the left, just some great returns, in the market over the second quarter of 2025. And it really feels like staring through a frosted window. You see the beautiful end results. It's like a smiling patient leaving the dentist, right? But you don't feel the drilling pain that got you to that point. Markets in Q2 looked extremely healthy on the surface, but underneath, we see, fragile profit and losses and balance sheets for companies, debt pressures, kind of like the dull headache you only notice when your anesthetic wears off. Tariff headlines and fiscal policy really whipping up uncertainty in the market, much like kind of your tongue when it's numb and you can't taste what's changing. And then a spending bill from the government that really promises relief, but the true costs kind of lurk out of sight and are still providing uncertainty. So while we see these uncertainties, we've seen a really strong market, and I think that speaks to some of the resilience from investors, particularly in public and private markets here in Q2.
As we look at the asset class performance up to this year, so you can see all the way to the right side is year to date. We see global markets tearing away, right? 19.9% 6-month return for Europe and the Far East there, emerging markets at 15%. And so what we've seen currently over the first 2 quarters is 2 consecutive quarters of the international and global markets outperforming the US market. A 6.2% rate of return through 6 months is a great return historically. So let's not poo-poo the returns of the US market. But as we talk about asset class diversification, as we talk about creating portfolios that are resilient no matter the economic cycle, we've been seeing over the last couple of quarters just a full out display of why that diversification matters. You'll also see commodities, making its way, whether that be real commodities, real estate, or gold, that are kind of finding their way as well. So we want to make sure those are diversified. And you'll see that through line, right? Your eye kind of draws to that dotted line that goes across, showing that those balanced portfolios, you're never at the top of the heap because you're always holding some asset classes that might be underperforming in that time period. But when we're going for consistent long-term growth, when we're trying to hit a family's plan or an organization's plan, that stability, holding all those asset classes really is the way to go to make sure that we're in the right place. So that's how we've seen the overall markets, but let's jump into a question, really what it's looked like for you. So we've got a post check here. Quick question for the chat. If your portfolio so far this year was an animal, what would it be? We've got a bull,
Of course.
traditional. I like it. Wall Street would be happy. I'm with the kangaroo.
Andrew, what do you think? What would your animal be?
Um, my animal would be an eagle. It's been soaring in the last 3 months or so. So took flight kind of above the fray, although it was a little choppy waters and maybe some storms down there. We didn't notice we were up there. So uh, Chris has got a butterfly. It's evolving. I love that. I love that. Jason, how about for you? How would you describe, the your portfolio or the portfolios this last quarter?
Yeah, I think a dolphin, swimming fast and gracefully through choppy waters.
Okay, okay. Okay, it made me think of a salmon upstream because it's definitely felt upstream recently. So that's great. So a rhino. I love it. I love it. Okay. Okay. So yeah, keep commenting there. But we have seen, a mixed bag of what expectations and results have looked like. And so as we look towards the next 6 months to the next 12 months, we're still keeping our eye on factors that are ever evolving. Great word, Chris. It's an evolving landscape. First, we're looking at the key index forecast earnings. We're seeing an earnings place where we're seeing some strong and some weak earnings, but we have seen across the board is a lot of stock buybacks. Almost a trillion dollars or $900 billion, a record high of stock buybacks, pushing some of those stocks up, and also a vote of confidence typically for the company and for the executives to buy back those pieces. So we're keeping our eye on those. We do have to watch whether it temporarily or artificially inflates pricing over time, but as a vote of confidence, that is something that we are seeing and we feel good about. Interest rate expectations. Interest rates have been holding pretty steady. We went in bullish on interest rate cuts in the beginning of the year. Now most economists are projecting one, maybe two cuts through the end of the year. And so we're keeping our eye there. We'll have a couple of talks on inflation later on that Jason will lead, but we are keeping our eye on those cuts. Global diversification is a big piece. As you've seen, 2 quarters simultaneously where the global markets are outperforming. A lot of that is due to the weakening dollar. Through the first half of the year, we've seen the US dollar index decrease by 11%, which is a significant decrease. That makes global equities a lot more attractive. And it also, is an indicator as we go forward of making sure we've diversified our portfolios, not only in, Europe and Asia, but also some of the emerging markets that are seeing a lot of success. The tariff piece is a ever evolving slide, right? We can, depending on the day, depending on the news cycle, we've got different indications. What we are seeing far and away now is that right now, US companies are absorbing these tariffs. They haven't changed pricing. Consumers haven't seen that. But as we keep our eye on inflation, we'll keep a word out or an eye out for what this changing tariff landscape means for the consumer balance sheet and for the business balance sheet as we go forward. And then we've got to think through market cycles and the volatility. In early April, the VIX hit a large high, which the VIX is an indicator of volatility or anxiety in the market. It has since subsided since that time, but higher anxiety or higher risk and volatility in the market, can force people out of the market to choose other asset classes or to hold cash on the sideline as things happen, and that's not good for market growth long term. So, we've seen this it subside for the volatility, but that's something that we're keeping an eye on. Looking forward is how that volatility will change different stock prices. Let's talk through some inflation numbers, though.
Absolutely. Oh, I see we've got a question in the chat. Thanks, Sarah. How do you separate noise from what really matters? I think this is an interesting dovetail into inflation expectations and actual inflation. I think we've got to really focus on economic data and indicators, whether they're leading or lagging. I think the news cycles can cause confusion in what actually is happening in the economy, whether it's kind of the corporate economy or the real economy and people's Main Street spending. I think this page and slide really reminds me of if you like squirt too much toothpaste, it's hard to put it back in the tube. And in 2022 and 2023, we saw elevated levels of prices and price increases. If you look at these two charts, every data point on the chart reflects how much prices have risen over the trailing 12 months from that dot. So, we tend to look at price increases or inflation, of all prices in the economy and then all prices without food and energy because those tend to be a little bit more volatile or kind of high swinging. This number is extremely important, right? Because it defines what the real value of your money will be worth in the future and how that's changed over the last 12 months and, looking ahead on this chart it goes into, as you want to think about your financial plan or your organization's investment policy, your inflation expectation or what you think inflation is going to be over the time horizon that it's going to take for you to reach your goals and objectives, is a critical variable in evaluation and making sure that you have enough dollars in future dollars to achieve your goals and objectives. So, I think everyone hopes things snap right back to what inflation was pre-COVID, but once innovation like AI has moved the needle, you really can't unlearn it, right? I think we've seen folks and expectations that are clinging to memories of, low pre-COVID growth, but the world has been rewired, right? Like we've seen AI cause innovation. We've seen de-globalization by, tariffs or onshoring manufacturing efforts from countries around the globe. Those are inflationary pressures that may continue to drive inflation up over the long term. And I think that this is moving on is just a chart of the volatility of returns. And you can see here, this chart is really showing how much the returns of a portfolio swings, during a certain time horizon. If you look at, over 1 year, portfolios being up 52% or down 37%, particularly those invested in equities, right? Versus a much, much tighter range as you look at a 20-year rolling average. I think this speaks to a number of things, right? Patience, discipline, cutting out the noise, really to address the last question. I try to make it comparable to a daily workout for your portfolio, right? Like each day's up and down volatility. Maybe one day you work out, another day you don't. Is equivalent to maybe like, okay, well, you may work out every other day or almost every day whether or not you work out is an up or down kind of binary volatility. But over a year's period, if you work out 200 times, your general health trends should improve, right? And as you work out 5, 10, 20 years on that same flow, the daily volatility of whether or not you worked out really goes away because you're healthier, you're in better shape, right? And the general trend has really improved. So I think that's really attributable to here. Like as we look at our investor portfolios and outcomes, how do we focus and make the right assumptions for the long term, like inflation, right, that we just talked about, but also about asset class returns that really drive what we think, the long-term horizons and goals of our clients can be met. I'll pause there, before moving on. Any questions, thoughts, Andrew, anything you want to chime in on this topic?
The only thing I'll add is we've been in probably a dozen meetings together where, we're advising it's really not about timing the market, it's about time in the market. And I don't think there's a more apt way of thinking about it that, setting the right strategy. Obviously, we're going to make tactical changes here and there, but if we've set the right portfolio and the right expectations to the right goal, that it's about really sticking to that plan. Um, and the time that we spend in the market really dictates our success. There was a lot of hesitation or anxiety around markets in March and April. And a lot of our advice was that, hey, we should stay invested. We should stick this out. This timing the market is really a tough game because you have to time it right twice. And so you have to get out at the right time and get back in at the right time. And so really riding that out, I think this quarter was one of those quarters that we can point back to and say, this is what it looks like when you stick to the plan and you can reap the rewards for biting the bullet and staying true.
Well said. With that, we've got some key takeaways that we want you to take away from this information. We're happy to share this deck or answer any questions and follow up. First takeaway, interest rates remain high, really to curb higher inflation. I think this is tightening financial conditions, so it makes it harder for companies and organizations to operate, right? So if the economy slows and we see consumers spend less, we see lower corporate earnings, things that are risky, like high yield credit or companies that are on the verge of, kind of right on the line, whether or not they can exist and be a going concern, may be extremely vulnerable, right? So I think that's one takeaway, right? We want to think about quality. The second is just AI and geopolitical fragmentation are intensifying, right? I think that this is an important consideration. AI is a new frontier for the global economy, and the way that countries interact and kind of share information, share data rights, and talk about tariffs and cut trade deals, I think are all driven around some of this new innovation that we're seeing in the economy that's driving prices and causing people to think about onshoring and tariffs and protecting their national economy. Lastly, we're seeing fiscal policy really boost growth for now, but rising US debt could pressure long-term bond yields and challenge the trust in the dollar. We, have been on this webinar before talking about long duration credit and some of the benefits of it. I think as we've seen new policy and new spending in the US, rethinking your credit duration and thinking about being short or intermediate over being long, I think is a really interesting point that we've come to here in markets. So these are the key takeaways. Thank you all for your engagement. I see we've got a question in the chat. After we address this one, we'll take any, if you want to come off mute and ask or put them in the chat, please do. Question from Mr. Grady. Thank you. You may have touched on this. What's your perspective on private markets and how they enhance risk-adjusted returns on a portfolio? Andrew, you want to take that one?
Yeah, I'll take that. We do have a high conviction around private markets being an integral part of a portfolio. There's a lot of data around just the sheer number of companies available in the private market versus what's available to invest in the public market. The public market, somewhere around 3,200 companies, the private market vastly larger than that. And so we do see it as an important piece. We've also seen over the last few years legislation that comes to deregulate how high the hurdle is to be involved in private deals. There's been an expansion of what a accredited investor is. Previously, you needed to have a net worth of $1 million or consecutive years of income of maybe $250,000 or $350,000 for a family. And there are newer caveats that are allowing more people access, whether it be through investment licensure or other ways that you're involved. But with that comes the burden of due diligence, which means that, for publicly traded companies, you can see their earnings reports are public. They have to go through compliance through the SEC for access to them. And in private markets, that's not that's not so. And so there is the added risk of being able to vet an investment and being able to know what to ask for and how to get involved. And so I do see a rise of certain platforms that will do that for you, right? We've had conversation with Honeycomb, Fundrise, all these things where you can invest in private deals, but they have a central convening mechanism for the data and being able to vet it and make the investments and get paid back, right? So there's a lot of mechanisms that make the private market a little bit tougher for the everyday retail investor. But by and large, we agree and have a high conviction that adding private markets can diversify down in risk and up in returns long term if done the right way.
I mean, Andrew said it, right? 98% of companies in the United States are private. And you may think, oh, well, there's all these small businesses. Well, 85% of companies in the US with revenues of $100 million or more are private. So this market is much bigger and more robust than public markets. Something we've taken up at Zenith is how do we democratize, bespoke private markets in different places, right? So like, how do we create access to invest in, a specific region, right? Or a specific type of entrepreneur or project. But this is a new frontier. So we're still figuring it out and trying to make sure it's efficient and accessible for our audience. Great question. Thanks.
Great question.
Any others? Absolutely, Chris. Thank you for attending. Thank you all for attending. This is a great addition, Q2 2025 Insights webinar. Andrew, thank you.